Hello and welcome to NJBIZ Conversations. I'm your host, Jeff Kanige. My guest today is Patrick Ryan. He's the CEO of First Bank and a great friend of the show. Patrick, welcome back.
Thank you, Jeff. Glad to be here.
Thanks for joining me. Appreciate you taking the time. I want to talk about first everyone's favorite subject, which is interest rates. And I know it's everyone's favorite subject because everyone's talking about it,
Right.
including and you and I have spoken about it in the past.
Sure.
I'm curious as to where you think we are right now, both in terms of what rates are and what that has done, what that's doing to spending and investment decisions, and what the expectations might be. First of all, when rates first started to go up, the line I heard over and over again was, yes, rates are higher than they used to be, but they're still not historically high, and they're still not sort of driving decisions the way a really high interest rate environment would do that. I'm curious, where do you see things now? What is your assessment of the current environment, number one? And number two, how is First Bank responding to it?
Yeah, well, listen, in theory, interest rate conversations should start with the economy, right? What's
Right.
happening with the consumer, what's happening with employment. This interest rate conversation is a little bit different given the administration and
Right.
their desire to get the Fed to move, sort of less independently than perhaps it's been in the past. But at the end of the day, in the markets where we're operating, kind of New York down through New Jersey, southeastern PA, things are pretty good. Ironically, to the extent that the economy is being held back, I don't think it's because of the level of interest rates. I think it's a
Okay.
little more the uncertainty, what exactly is going to happen with, the tariffs, what exactly is going to happen with Doge. Doge isn't really in the headlines anymore, but
Right.
there's still a lot of conversations being had about cutting back of government departments and government spending and what does that do to the economy and how does that impact things depending on your line of business. So I think in general the mindset right now for the business owner is, hey, we're not cutting back, we're not stopping, but we're also maybe not making the big investments for growth because of some of that uncertainty. So I
Okay.
do think if, we can get some final closure around tariffs, what exactly are they going to be and how much of an impact is that going to have? And, if the cuts to the government departments aren't so deep that it starts to impact the organizations that are servicing those departments, I think you could really see an uptick in economic activity. But again, I don't think it's going to be, hey, we lower rates 25, 50 basis points. All of a sudden people are going to start investing. I think
Okay.
I think they'd be willing to invest today at current rates. Now, that being said, is the Fed going to move? It looks like they probably are. If
Right.
you'd asked me 3 weeks ago, I'd say, I don't know. It felt like we were at a reasonable balance between inflation and unemployment, the dual mandate, and it didn't feel like there was a need to cut. But, Powell came out and said, hey, we see the risk now to the downside in terms of employment. And so
Mhm.
we think we're currently at a level that's quote unquote restrictive. And so we may start to lower a little bit to try to get ahead of potential declines in the level of employment or
Right.
increases in the level of unemployment. But, you know, I don't think it's a function of the economy totally sputtering. I just think the Fed has decided for whatever reason that if the long-term level of rates they want to be kind of in the 2 to 3% range, and they're above 4 right now, maybe they want to slowly start moving them down. But again, I don't know that that's going to have a huge impact on economic activity until some of those other factors of uncertainty kind of get put to bed. So,
Okay. Well, that's interesting because I was going to ask you about uncertainty because I heard that a lot in the first half of the year, especially around tariffs. And around the possibility of a recession later in the year, that there was a lot of hesitancy to make those kinds of big decisions. What I'm hearing you saying is that there is still some of that lingering uncertainty right now, even if maybe the headlines aren't quite what they had been earlier in the year.
I think that's right, Jeff. And, obviously I'm speculating a little bit based on conversations we've had with some of our customers.
Okay.
But, I think 6 months ago, if you'd asked folks, hey, are you going to make any big investments? The answer would have been, heck no, we're not even close to thinking about that. I
Right.
think right now, people are closer to feeling like, hey, maybe some of the worst case scenarios are off the table, but I'd probably still like to have a little more visibility into what the future looks like before I want to make those big investments. I think people are spending money today, right?
Mhm.
Think of it as sort of maintenance CapEx versus going out and buying a really big new piece of equipment or buying a new building. I think people are still looking for a little more certainty on the tariff side before they're going to start making the big investments. But I think they're closer today than they were 6 months ago, just because some of those really bad scenarios don't seem to be playing out. And so I think people are probably getting closer to the point where you really might start to see a pickup early next year. If rates come
Okay.
down a little bit, if a few
Mhm.
more tariff deals get done, I think you could be in a position where the economy could really start to hum.
Okay, because there was a sense. I mean, what that uncertainty I was told was leading to was a sense that folks were, if they were spending money, they were doing it to get ahead of tariffs, to get inventory in, so that they would avoid the worst impact of tariffs. Has
Right.
that now worked itself through, and our businesses just sort of waiting and seeing what happens next?
Well, listen, I think at the end of the day, tariffs is a singular word that really means lots of different deals with lots of different countries, right? A
Okay.
few deals have gotten done. Businesses with exposure to those specific countries probably feel a little bit better right now, right?
Okay.
Folks that have exposure to China, right? China, who knows what's going to happen with China? China's the second biggest economy in the world. That's still a pretty big uncertainty floating around out there. So I think as more and more tariff deals get finalized and people realize, we're not going to go in this back and forth, kind of crazy scenario, then I do think that confidence will build. I just think, in my opinion, it'll take a little more time, a few more tariff deals getting done, and or something with China meaningful getting done. I think will put some of this uncertainty behind us.
Okay. Now you mentioned the Fed and its calculations, and yes, when Chairman Powell said that they were considering rate cuts, it seemed to be a direct result of a fairly weak jobs report. On the other hand, inflation is still running above the Fed's target. If they do cut rates, would that add significantly to the inflationary pressures that tariffs might also put on? And if so, what effect would that have on the economy generally?
Yeah, I mean, listen, that's the reality, Jeff, is that there's risk of increased inflation, right? If you really start to see an uptick in economic activity on top of the additional tariffs, you could see inflation start to kick back up again. To me, the biggest irony is, the revised employment data came out. The administration said, "Hey, those numbers aren't right. Let's get rid of the person who made the numbers."
Right.
But ironically, those numbers were the only reason why the Fed's now thinking about lowering rates. So it's sort of like, well, if the numbers are wrong, then the Fed shouldn't even think about lowering rates.
Mhm.
So, you're in a little bit of this catch 22. But I think at the end of the day, there's certainly a risk for inflation heating back up again,
Mhm.
especially if the economy starts to hum early next year. But I think the Fed's basically saying, hey, if that happens, then we'll respond accordingly. But right now, the data is inching us towards, fear of unemployment going up more so than fear of inflation. But, the next round of reports, they might have a different view. So,
Right.
we tend to think of things as, oh, here's what the Fed's going to do. And so that's what they're going to do for the next, 6 months or 2 years. No, that's what they're going to do at the next meeting. And then they're going to go look at a whole bunch of updated information and make a decision at the meeting after that. So I think the Fed's basically saying, hey, we're willing to slowly move towards neutral, right? They think they're restrictive right now. We'll move towards neutral. But obviously, if we need to readjust because inflation picks back up, then I think they will.
Okay. So what is First Bank's calculation then? When you look at this? I mean, the last time we talked, I think you said that you felt like the worst aspects of the low interest rate environment had sort of worked its way through the system. Is that where you are now? Are you still looking forward to what you were looking forward to back then? Are you still expecting growth? Are you still expecting the bank to do well in this environment?
Yeah, I mean, listen, we try hard to position ourselves so we're not overly exposed to rates moving one way or the other, right?
Okay.
In theory, there's risk on both sides. Right now,
Mhm.
I think everybody says, hey, they're either going to go down or stay flat. That's probably right. But we try to manage our balance sheet so we're not overly exposed to big upticks and big decreases. So when the Fed started to move quickly a couple of years ago, thankfully, we weren't totally immune from the pain that caused, but we were in a decent position where we still had good earnings and we weren't overly penalized by that move in rates higher. We're now at a position where we're relatively neutral again. We think if the Fed lowers a little bit, we can manage that. Even if they ended
Okay.
up moving higher, we can manage that. So, our job is to try to manage that interest rate risk so that we can continue to be active providers of capital in any rate environment. And that's sort of where we position ourselves today. So, I think the level of economic activity right now is strong. And if rates come down, I think it'll stay strong or even go up a little bit. But I think we at First Bank are well positioned to do well in that environment.
Okay. And your community bank, a regional bank, you're close to what's going on in New Jersey. I'm
Right.
curious as to how you view the state's economy. I mean, we have a gubernatorial election coming up. The assembly is all up. It's a big election year. There might be some political uncertainties around that. What are you seeing locally in terms of how businesses are again planning for the future?
Yeah, and again, if we just focus on our customer base, folks are generally doing pretty well, right? There's obviously some things they needed to do to blunt some of the impact of the tariffs to the extent that they were impacted. But, folks had built a pretty good cushion in terms of their profitability that they were able to withstand some price increases. They, didn't have overhead issues they needed to worry about. And so, folks are still making money. They're still active. And to me, the biggest issue in New Jersey is, state government spending, unfunded pension liabilities. And, unfortunately, that's not getting any better, right? That's just getting worse. And we don't
Hmm.
seem to have any real appetite for tackling that issue. And so, while we live in a state with, significant budget deficits, significant unfunded pension liabilities, and high taxes, though that's not the recipe for driving growth in a state, right? I think we
Right.
all understand that. So I think there are some real structural issues that need to get addressed by whoever is the next governor that comes in. But, in the meantime, those are all known problems, and people get
Right.
up every day, they go to work, they do their business, they buy stuff. So the overall level of economic activity is okay. It's just this sort of slow bleed of, high earners leaving the state and, a little bit of outward migration with growing deficits. That's all long-term problems, but it's not necessarily stopping people from doing business today.
Okay. All right. Well, that's an interesting way to put it. I was curious about what you were seeing because again, it's a long-term problem. We keep hearing about it, and yet the economy just sort of keeps chugging along. As you said earlier, it just seems to you know maybe it's not supercharged, but it's still working to a certain extent.
Yeah, I mean, listen, at some point, right, if New Jersey can't borrow money to fund deficits, that's when
Right.
the rubber meets the road, right?
Right.
Most folks in New Jersey have decent incomes and the ability to, pay for what they need. And, you know, to the extent that we're pushing tax dollars out of the state, that's just making the long-term issues worse. But, New Jersey remains a very, high level of income, high population density, high wealth. So there's plenty of dollars here to keep the economy churning. At some point, if the state can't borrow the way they borrowed in the past, that could be the impetus for larger problems within the state. But in the meantime, I think, folks are going along business as usual.
Okay. And along those lines, I'm curious again about First Bank in particular. You recently announced opening two new branches, one in Trenton, I think, another one in Pennsylvania. What I've been hearing, what we hear, have been hearing all along, at least for the last several years, is that the trend is away from brick and mortar schools, brick and mortar locations, especially in the wake of the pandemic when folks stopped going to the bank regularly. What's your
Yeah.
thinking there? How are you sort of bucking that trend?
Yeah, listen, I think the fundamental trends of fewer bank branches will continue. I think you'll continue to see big guys making headlines talking about all the branches they plan to open.
Hmm.
What's not in the headlines is they got, two they're closing behind the scenes for every new
Right.
one they're opening, right? So
Hmm.
that is happening. And, even, at First Bank, I'd say in a typical year, we might open two new, consolidate one, open two new, consolidate one. Now that's obviously net growth for us
Right. Right.
because we're a growing institution. But for a lot of organizations, especially that have been around for a long time, now we got going back in 2008. And so we're relatively young for a bank. And so we didn't have lots of legacy brick and mortar that needed to be consolidated. If,
Hmm.
if our bank were 150 years old, the old model was, hey, every 3 miles you plopped open a new branch and that's how
Right.
you service your community. Well, now, you probably need one branch for a 10-mile radius versus three within that same area. And so those natural trends of branch consolidation will continue.
Okay.
But, the factor that's offsetting it a little bit is, at least today, the branch still matters, right? People are going in less, they're using it less.
Right.
But it's still important to them when they're deciding, who am I going to choose to do my banking with? They like to know there's a branch nearby, even if they don't go quite as often as they used to. So I think you'll continue to see new locations come online. I think they'll be smaller. I think they'll be a little bit more efficient. But, behind the scenes, you're going to continue to see closures and consolidations as well.
Okay. All right. And the other kind of consolidation that, again, that seemed to have reshaped the industry was consolidation of banks themselves, particularly among community banks.
Right.
Has that continued, number one? And number two, what's been the effect on both the financial services industry and the businesses that rely on you guys?
Yeah, listen, I think at the end of the day, there will be continued community bank consolidation, but I think it'll be a lot of community banks partnering up with community banks. So at the end of the day, the name may change, but the customers that want to deal with community banks will still have that community bank available to them, right? I don't think the community bank model is going away. I
Okay.
do think the community bank of the future will be a little bigger, right? It used to be you were the bank of the town, and then after a while you became the bank of the county or maybe the bank of the state. I think you're going to have more regional community banks so that they have the size and the scale that's necessary for the technology investments, the regulatory risk management requirements, and at the end of the day, the efficiency you're going to need to generate a reasonable return, right? A lot of banks are publicly traded. Their shareholders expect a return on capital. So those things will continue to churn. So I feel bullish about the community bank model. I think the future is larger community banks, but I think the good ones will be ones like ourselves that can maintain that community bank essence as we get bigger, right? So we're stay nimble, stay flexible, stay responsive, provide great service. I think you can do that, right? There's probably a size at which the bureaucracy overwhelms the institution, but to me, I don't know what that number is, but it's 50 billion, 100 billion, whatever it is. It's pretty far away from where we are, and so I
Okay,
think.
well, okay, well, that's what I was going. That was the last question I was going to ask you was, where is First Bank in that
Yeah, I mean, listen,
landscape, in that universe? Where do you fit?
Yeah, we're 4 billion in assets. We cover a pretty good geographic area between New York and Philly and parts of eastern central Pennsylvania, a little bit down into Delaware, a little bit up into New York. So we got a pretty big sandbox to play in terms of the
Right.
overall level of economic activity, the level of deposits in the market. We're at 4 billion today, so in theory, we could grow 10 times our current size and still be below this sort of made up threshold I came
Okay.
up with that
Right.
said you'd have to be
Okay.
a different organization. So again, I think you'll see continued consolidation. I think what you'll see is, instead of big banks buying small banks and sort of obliterating them, you're going to have community banks partnering up
Okay.
because they want to maintain that community bank culture, that community bank model. And so I think it'll thrive. It'll just be bigger.
Okay. And there has been some of that, and I'm guessing that when you see that, and when you hear that, when your customers, when your clients hear that, they're okay with it. They don't see the community banks growing too big at this point. It's still
I don't
the
think so.
local person. The relationship is still there.
Exactly. I think as long as, most community bank customers aren't banking with that bank because the name on the door, right? We
Right.
don't have this huge brand recognition that the big guys have.
Right.
It's because they're getting great service, because they have a great relationship with the personal banker. And at the end of the day, switching's a big pain, right? So if two community banks come together and
Right.
service doesn't falter and they still have a great relationship with their banker, I think they're going to be happy and they're going to stay.
Okay. Yes. Well, I can certainly attest to that. Patrick Ryan, CEO of First Bank. Thanks for spending the time. I appreciate it, and I hope you come back and continue the discussion at some point.
Thanks, Jeff. Would love to do it. Appreciate being here. And thanks again. Great to see you.
Great. And thank you for watching. Until next time, stay safe, everyone.